Look, here's the brutal reality I need you to understand right now. If you're trying to buy a home in America today, you're not just facing challenging times. You're witnessing the systematic dismantling of the most fundamental pathway to middle-class wealth building in this country's history. And what's about to unfold over the next 18 months will make every previous housing crisis look like a minor hiccup compared to the economic devastation that's already begun. The American dream of homeownership isn't just under attack. It's been mathematically eliminated for 74% of Americans under 40. Think about that for a second. 3 out of 4 young Americans are now permanently locked out of homeownership. Not temporarily struggling, but mathematically eliminated from ever owning property under current conditions. This isn't hyperbole. This is data straight from the Federal Reserve's latest report that they buried so deep in their findings that most people will never see it. I know you're probably exhausted from working harder than your parents ever did just to afford rent that's doubled in the last 5 years. And I understand the crushing weight of watching home prices climb further out of reach every single month while your savings get destroyed by inflation. But here's what they don't want you to know. This housing crisis isn't just another market cycle that will eventually correct itself. It's a complete structural collapse of the homeownership model that's been engineered by forces far more powerful than simple supply and demand. I've spent an enormous amount of time researching this crisis from every possible angle. Now, here's the truth about why America's housing market has been destroyed and what comes next. And this is not going to be any other coverage you've seen. I'm going to tell you exactly what you can do about it, so you don't get absolutely devastated when the next wave hits. Let's get into it. So just so you have context for what we're dealing with, according to the latest data, home prices are now 47% higher than they were in early 2020. The median home price has reached 5 times the median household income. That's not a typo. 5 times. To put that in perspective, historically, a healthy housing market sees prices at 2.5 to 3 times median income. We've nearly doubled what economists consider sustainable. But it gets worse. Monthly mortgage payments on median-priced homes now require $2,570 under typical first-time buyer terms. Buyers need an annual income of at least $126,700 just to afford this payment plus taxes and insurance. Here's the devastating part. Only 6 million of the nation's nearly 46 million renters can meet this benchmark. That means 87% of renters are mathematically locked out of homeownership at current prices and rates. Comment below what you think about needing to earn more than double the median household income just to qualify for a basic home mortgage. It's absolutely insane what's happening to hardworking Americans right now. But here's what's really terrifying about this situation. The Federal Reserve's interest rate hikes brought the average rate on a 30-year fixed mortgage to a 2-decade high of 7.8%. That means a home that would have cost you $1,400 per month with a 3% rate in 2021 now costs $2,800 per month at 7.8%. That's a 100% increase in monthly payments for the exact same house. Your buying power didn't just decline, it got cut in half overnight. Subscribe to this channel right now if you want to understand the real forces behind this crisis, because this information could save your financial future. Let me break down exactly what destroyed the housing market, because there are 4 critical factors working together to create this perfect storm of destruction. First, the lock-in effect has created an unprecedented situation where homeowners are essentially trapped in their current properties. Homeowners with mortgage rates below 4% are completely unwilling to sell and forfeit their advantageous financing. Just think about this mathematically. If you have a 3% mortgage and you sell your home, you'll have to buy your next home at 7% or 8% rates. That's not just losing your low rate, that's financial suicide for most families. This has created what economists call the most severe inventory shortage in modern history. Just 1.1 million homes were available for purchase in March 2024, down 34% from March 2019. This is only 3.2 months of supply, even with drastically reduced sales activity. Annual home sales dropped 19% in 2023, hitting nearly a 30-year low. When you have this kind of supply shortage combined with persistent demand, prices can only go in one direction. Second, the supply deficit represents a fundamental structural problem that's been decades in the making. According to Realtor.com, the United States currently has 3.8 million fewer housing units than Americans actually need. Even at the current increased rate of construction, it will take 7.5 years to close this supply gap. But here's the really disturbing part. In some regions, it's much worse. The Midwest would take 41 years to close the gap, and the Northeast may never see an end to the crisis. The reason for this shortage traces back to the years following the 2008 financial crisis, when the country massively underbuilt in the face of new family formation and growing demand. Home builders never fully recovered from 2008, and then the pandemic created a run on housing that caused supply to drop to record lows for several years. Home builders simply couldn't keep up with demand. Third, regulatory costs have become a massive hidden tax on new construction. About 24% of the cost of a single-family home and 41% of the cost of a multifamily home are directly attributable to regulatory costs at the local, state, and federal levels. A 2021 study found that regulation accounted for $93,870 of a typical new home's final price when the average home cost $394,300. Now that homes cost $484,000, that regulatory burden has grown proportionally larger. Local zoning laws are particularly devastating. It is difficult to overstate the role local zoning and land use regulations have played in creating the affordability crisis in most urban areas. In San Francisco, it takes an average of 627 days just to get approval to build a single home. In Boston, it's 548 days. These aren't construction times. These are just approval processes. Meanwhile, local governments actively prevent new construction to protect the property values of existing homeowners who vote in local elections. And fourth, demographic shifts are creating massive pressure on an already broken system. The reason household formation and why new construction finally outpaced new 2024 is sobering. At least 1.6 million expected Gen Z and millennial households did not form because they couldn't afford housing. In short, people are not settling down and becoming homeowners because the system has priced them out entirely. Like this video if you think this housing crisis represents a complete failure of American economic policy, because what I'm about to show you next will prove that this wasn't an accident. These conditions were created by deliberate policy choices that favor existing homeowners and institutional investors over young families trying to build wealth. The rental market offers no escape from this crisis. Half of all renter households, 22.4 million in total, spent more than 30% of their income on housing and utilities in 2022. That's up 2 million since 2019 and represents the highest number on record. Rents have been rising faster than incomes for decades, but the pandemic-era rent surge produced what experts call an unprecedented affordability crisis that continues today. Here's what's particularly devastating for younger Americans. The average first-time homebuyer is now 36 years old, up dramatically from previous generations. As of the first quarter of 2024, the homeownership rate for Americans under 35 has collapsed to 37.8%, the lowest since tracking began in 1982. But here's the really shocking part. Internal Federal Reserve projections show this falling to just 24% by 2030. We're watching the complete dissolution of middle-class wealth building in real time. The pathway that allowed previous generations to build generational wealth through real estate has been systematically destroyed. And what's coming next will determine whether American families ever regain the opportunity to own homes and build wealth for their children. But here's where this story takes an even darker turn, because the forces I've described so far are just the visible symptoms of a much deeper problem. The invisible hand manipulating this entire crisis belongs to institutional investors who have fundamentally altered the nature of American housing. While families struggle to compete for the scraps, Wall Street giants are systematically converting homeownership into permanent rentership on a scale that would make feudal lords jealous. Here's the data they don't want you to see. Institutional investors now own 1 in 7 single-family homes in America. But in cities like Atlanta, Charlotte, and Phoenix, that number jumps to 1 in 4. These aren't small-time landlords with a few rental properties. We're talking about Wall Street behemoths backed by unlimited capital, buying entire neighborhoods with cash offers 20 to 30% above asking price. Internal documents from major institutional buyers reveal their 5-year plan to own hundreds of thousands of single-family homes. They're not buying these homes to flip them, or even to be traditional landlords. They're converting permanent homeownership into permanent rentership, creating a subscription-based housing model where you'll own nothing and they'll control everything. In Jacksonville, Florida, institutional buyers now control 43% of all single-family rentals. In Memphis, it's 38%. These corporations use algorithms that can evaluate and bid on properties in milliseconds, making it mathematically impossible for regular families to compete. You're not just competing against other families anymore. You're competing against artificial intelligence backed by trillion-dollar asset management firms. Comment below if you've tried to buy a home recently and lost to a cash offer. I guarantee most of you have this exact story because it's happening millions of times across the country every single day. But the algorithmic manipulation goes even deeper than direct purchasing. Major real estate platforms use proprietary algorithms that have been proven to inflate price estimates by 19 to 27%. These inflated automated valuations become self-fulfilling prophecies, pushing prices higher based on fictional assessments. When investigators looked into this, they found coordinated data sharing between platforms that violates antitrust laws. But no action was taken because the same financial interests that benefit from inflated prices also influence regulatory policy. The shadow inventory that banks and institutions are holding off-market represents another devastating manipulation of supply. Banks are currently holding 1.7 million properties in various stages of foreclosure that haven't hit the market yet. They're releasing them slowly to avoid price crashes and maximize their returns. Add the 5.2 million properties that are 90-plus days delinquent, and you have potential inventory that would take 14 years to absorb at current sales rates. Here's what makes this particularly sinister. They're deliberately constraining supply while families struggle to find homes, then releasing inventory strategically to maintain price levels that benefit their portfolios. It's market manipulation on a scale that dwarfs anything we've seen before, and it's completely legal because the regulators who should be stopping it are captured by the same interests perpetrating it. The insurance apocalypse represents the next wave of this crisis, and it's about to get much worse. Major insurance companies have collectively withdrawn from writing new policies in California, Florida, and Louisiana. According to industry data, 12.7 million homeowners are now forced into state-run insurance programs, charging 300 to 400% more than traditional coverage. In Florida, the average home insurance premium hit nearly $11,000 this year. That's almost $1,000 per month just for insurance. But here's what they're not telling you. Internal insurance industry reports show that by 2027, 31 states will be considered uninsurable for climate-related risks. We're not just talking about coastal states. This includes Tornado Alley, wildfire zones, and floodplains that cover 67% of American homes. The insurance companies know something the public doesn't, and they're getting out before the collapse accelerates. When insurance becomes impossible to obtain or afford, mortgage companies can legally force the sale of your home. It's already happening in Louisiana, where 47,000 homes were forced sold last year due to insurance noncompliance. Property taxes represent another hidden weapon being used to extract wealth from homeowners. According to recent data, property taxes have increased 109% nationwide since 2019, but home values have only increased 47%. In Texas, homeowners are seeing property tax bills that exceed their original mortgage payments. I just reviewed a case study of a family in Austin whose property taxes went from $6,000 to $18,000 in 3 years. They make $85,000 per year. After their mortgage and taxes, they have less disposable income than when they were renting. The mathematical impossibility becomes clear when you realize that in states like New Jersey, Illinois, and Connecticut, the average property tax bill now exceeds $12,000 per year. That's $1,000 per month, just in taxes forever, even after you pay off your mortgage. This is creating what economists call tax-forced displacement. Homeowners who own their properties free and clear but can't afford to keep them. The American dream becomes a financial nightmare where you never truly own your home because the government can always tax you out of it. The demographic catastrophe that economists won't discuss publicly is equally devastating. Census data shows that household formation among 25 to 34-year-olds has dropped 38% since 2019. Marriage rates hit an all-time low. Birth rates collapsed to 1.64, well below replacement level. When young people can't afford homes, they don't form families. When they don't form families, future housing demand evaporates, and the entire economic model breaks down. This isn't just a housing crisis. It's a civilizational crisis where the basic building blocks of society, stable families and owned homes, become impossible for the majority of the population. Japan experienced this exact trajectory, and their property market has been in decline for 3 decades while their population ages and shrinks. The Federal Reserve's own internal documents reveal they're preparing for scenarios most Americans can't imagine. They're modeling for a 50% home price correction in stress test scenarios. The Federal Reserve doesn't run models for impossible events. They're preparing for this outcome while telling the public everything is under control. The fact that they're seriously considering this scenario means they see it as a real possibility within their planning horizon. When the people who control monetary policy are preparing for a 50% housing crash, while publicly maintaining that everything is fine, you know the situation is far more dangerous than they're admitting. But here's where this crisis transcends housing and threatens the entire economic foundation of American society. The commercial real estate collapse is bleeding into residential markets in ways nobody expected, and it's about to trigger a cascade of bank failures that will make 2008 look like a practice run. According to the latest data, $1.5 trillion in commercial real estate loans mature by 2025. With office vacancy rates at 23% nationally and the retail apocalypse accelerating, these defaults will crash the regional banks who hold 71% of these loans. When regional banks fail, residential lending freezes completely. It's already starting. Regional bank residential lending is down 47% year over year. These banks originate 63% of residential mortgages. When they fail or restrict lending to preserve capital, the mortgage market effectively shuts down. Cash becomes the only way to buy, giving institutional investors complete market control over what's left of American housing. The Conference of State Bank Supervisors has 287 regional banks on their watch list for potential failure. That's not a small number. These are the institutions that provide mortgages to regular families. When they collapse, which many will over the next 18 months, the credit markets that enable homeownership disappear overnight. But the most terrifying aspect of this crisis is how it's accelerating wealth inequality at a pace that threatens social stability. According to recent analysis, the Hispanic homeownership rate sits at 49.9% and the Black homeownership rate at 46.6%, compared to 74% for white households. The white-Hispanic homeownership gap is 25.2 percentage points, and the white-black gap is 27.7 percentage points. These aren't just statistics. These represent millions of American families being systematically excluded from the primary mechanism of wealth building in this country. When homeownership becomes the exclusive privilege of the already wealthy, you create a permanent class system that destroys the social mobility that built American prosperity. The international capital flight that's occurring right now signals that smart money sees something average Americans don't. Foreign investment in American real estate is down 54%, with Chinese buyers, who were the largest international segment, down 78%. When international capital flees a market, it's because sophisticated investors with access to the best information see catastrophe coming. Saudi sovereign wealth funds just dumped $4.7 billion in U.S. residential holdings. When oil money exits real estate, it's historically been a signal that massive corrections are imminent. These investors don't make emotional decisions. They have access to data and analysis that most Americans never see, and they're running for the exits. The energy cost explosion is making homes unaffordable even for those who own them free and clear. Heating and cooling costs are up 147% since 2020. In New England, the average winter heating bill now exceeds $4,000. Combined with skyrocketing property taxes and insurance costs, retirees on fixed incomes are being forced to sell homes they've owned for decades. This isn't just a housing crisis anymore, it's the complete restructuring of American society, where homeownership becomes a luxury reserved for the wealthy elite while everyone else becomes permanent renters in a corporate controlled feudal system. The math is brutal, the timeline is accelerating, and the forces behind this destruction are more powerful than most people realize. But now you know the truth, and that knowledge is your only defense against what's coming. Stay informed, stay prepared, and understand that the housing market you grew up believing in is already gone forever.